Good evening. I thought I'd share with you my observations from our homework from Startup Finance Class 2. So on the balance sheet, some things I noticed there was that there was $100,000 in cash at the end of the year, December 31. And now actually looking at all three of them, I was thinking they were all the same company. So I guess this really doesn't matter so much now as I did before, but I was thinking, wow, that's a lot of cash in the checkbook, and they could have paid off their financing on the cash flow, but that would have been if it was the same company, so never mind. Number two was there was $160,000 in loans, and something I noted about that was that for their long-term liabilities, it could be for both land and vehicles combined, and that would make sense why it would be more than the land itself. Number three, owner's equity went up for this business, and so was actually, no, not up, it was quite high. So I would think that they've been in business at least a couple of years, because it would probably take quite a bit of initial investment to have that high of an owner's equity in either year one or two, I would guess, just from my experience. Maybe, but that's my observation on that, I guess. Number four, their supplies of about $3,000 makes sense to me. It seems to be in line because their asset amount of equipment was $0, so it would kind of make sense in my mind that if they have $0 in equipment, they probably wouldn't need to spend much money on having supplies on hand either. So those are my notes from the balance sheet. For the profit and loss or the income statement, date range, I think it would be easier. Now I guess having looked at all three of them, they probably are for the year ended 12/31. But I do know that when I've put together some income statements, it's possible to have a date range so that it says January 1 to December 31. That way you know exactly when that time period is, and that would probably really help for clarity, because I know even when we were looking at it in class, it was, wait, is this for a month? Is this for the whole year? Etc. So I thought it was interesting that they have separate line items for labor and salaries. Salaries was like, $140,000, and labor was $40,000. So they must not be on salary. That just, maybe that's contract labor, or anyway. So I thought that was interesting because we had talked before about the number one expense being labor, and so when you add those two together, it's definitely their number one expense. And then number 7, the third one on this sheet, on this statement, was just in general, the fitting together of all the statements. And this was the question I was going to ask in class, and then decided maybe I would just share my thoughts, and if it's wrong or it doesn't make sense, you can help set me straight. But it was going to be the fitting together of all the statements. So all three statements are important, but they all work together. So for instance, you have to lower your tax liability, or at least minimize it, but you still have to show a profit, because that's what a banker needs to see, and or an investor, and you have to keep your equity amount growing. So I've found it's interesting that just because you don't pay taxes doesn't mean that you can show losses on your profit and loss year after year after year, because at some point you still have to make some sort of a profit and pay taxes. I would imagine if you're making a profit, you have to pay something in taxes, and because that's something a banker would need to look at. Not that you have to go through a banker, but I don't know. That's what I'm finding, is you might have to go through a banker, and how you have to keep your equity growing somehow. Okay, third statement. Cash flow. Okay, first observation, number 8, would be, okay, so if the operations were negative, then you'd need to borrow money. So at the first part, so if it costs more to operate your business than it does for money coming in, you'd need to borrow money. That's my observation on that. and how on the investing part, it doesn't, that piece of the statement doesn't necessarily talk about outside investors. It just kind of talks about a plus or a minus in the asset category. So I thought that was interesting because, I don't know, I guess I was thinking about how many businesses actually have outside investment not coming from a bank or some sort of a loan type situation. So yeah, that was interesting. I wonder if I'd ever need to be in that position where I'd need to keep track of investment money and if it goes on that statement or not. And then number 10, final observation, was that you might need financing in January and that it's possible that you can pay it all back in December depending on how your year goes. You might just need to have your cash on hand to get going for financing at the beginning, but then you might make enough during the year. And if you're a good steward of your cash or your money or your revenue that comes in, you could probably even pay it all back come the end of the year and still be good to go for your next operating year. Anyway, so thanks for the assignment, and I learned some, and if you have any comments on this, I'd love to hear them, and I can learn from that also. So thanks. Have a good evening.